All right, let's jump right into this explainer. Today, we're taking on a massive, honestly fascinating topic that affects every single one of us, even if we don't always realize it. We're going to decode the very DNA of a nation's global finances. If you've ever wondered how a whole country manages to balance its checkbook with the rest of the world, or how international wealth is actually tracked, you are in the exact right place. We're going to deconstruct the balance of payments ledger, row by row, and really unlock the secrets of how nations track their economic pulse. So here is our roadmap for today. First, the macro definition. Second, the inflow and outflow law. Third, the current account grid. Fourth, the capital account grid. And finally, number 5, the golden core distinction. Let's get right into it.
Starting things off with part 1, the macro definition, our global ledger.
Now, before we start looking at the specific rows and columns, we need to know exactly what building we're standing in, right? So, what is the balance of payments, or the BOP as we usually call it? Well, it's a systematic record of all economic transactions between the residents of a country and foreign residents over a given timeline. And the absolutely crucial word to zero in on here is all. We are tracking literally every single economic interaction that crosses a nation's borders over a specific period, which is usually a year. Whether we're talking about a multi-billion-dollar corporate merger or just you buying a $20 cheese shirt online from overseas, it all goes into this ultimate macroeconomic receipt.
Moving right along to section 2, the inflow and outflow law, left versus right.
To establish the fundamental rules of our matrix here, we're going to focus heavily on spatial directions just to keep our accounting straight. On the left side, we have our credits. This side maps every single way a nation acquires foreign exchange. Put simply, this is money flowing in. On the right side, we have our debits. This side tracks exactly how a nation spends its foreign currency. That's money flowing out. So the main takeaway is that the left-hand credit side is always beneficial for the balance because, well, money is flowing in. It's building up our reserves. The right-hand debit side maps where and how a nation is sending its wealth abroad. Left is in, right is out. Pretty simple, right? Let's start applying it.
Okay, part 3, the current account grid, trade and transfers.
The current account records transactions relating to the export and import of goods, services, unilateral transfers, and international incomes. You can basically think of this account as the one that calculates the value of a nation's exports minus its imports, and then perfectly adjusts that baseline number for any international incomes and net transfers. It's essentially the day-to-day income and expense tracking of the entire nation. Let's actually look at the accounting rows for this grid. Up in row 1, firmly on the left-hand credit side, we have the export of goods. Down in row 6, on the right-hand debit side, we have the import of goods. These specific rows capture what we famously call visible trade. And why visible? Because this consists entirely of tangible, physical merchandise.
Let's make this tangible. Here are some concrete examples of visible trade: cars, aluminum, tea, iron ore. These are physical goods. You can literally stand at a seaport or a border crossing and watch these things cross a country's boundaries, being loaded onto massive cargo ships or freight trains. When a nation exports these items, say selling iron ore to another country, we get foreign currency flowing in. That goes on the left as a credit. When we import a fleet of cars, our currency flows out to pay for them. So that goes on the right as a debit.
But as we all know, the modern global economy isn't just made of physical stuff in shipping containers. Contrast those tangible goods with the concept of invisible items. These are transactions that just aren't tangible and cannot be seen with the naked eye crossing a border. To make sense of them, economists split these invisible items into 3 distinct groups. Let's systematically break down these subcategories.
Invisible Group 1 is services. Think of industries like shipping, banking, insurance, and tourism. If foreign tourists come to our country and spend money on hotels and tours, or if our domestic banks provide financial services to foreign clients, well, payments are received. Money is flowing in, so those go on the left, credit side. But if our residents travel abroad for a vacation or use foreign shipping companies to move goods, payments are made to foreigners. Money flows out, so they hit the right debit side.
Invisible Group 2 consists of unilateral transfers. This includes free gifts, donations, family cash remittances, and even things like war damages or indemnities. What really sets these apart is that they are essentially one-way transactions. There's no immediate good or service being swapped back in exchange. It's like relatives working abroad and sending cash back home to their families, or a government receiving a free donation for disaster relief. Again, if it comes in, it's a credit. If a country sends aid out, it's a debit.
And finally, Invisible Group 3, incomes. This category breaks down into investment interest, dividends, profits, and employee wages.
This is all about investment income earned abroad and compensation received by residents working for non-residents. For example, if our citizens own shares in a foreign tech company and receive a dividend, that's income flowing into our matrix, making it a credit. If we pay out profits to foreign investors who, say, built a factory in our country, that's income flowing out. That's a debit.
All right, moving to Section 4, the capital account grid, shifts in stock. If the current account is the day-to-day income, the capital account is the overarching investment portfolio. It tracks stock magnitude shifts relating to physical and financial assets, encompassing both short-term and long-term movements. This section of the ledger isn't about the goods we traded today. It is entirely about tracking changes in what a country owns versus what it owes over time.
And this brilliantly illustrates a concept that honestly trips up a lot of people. Foreign borrowing represents an import of capital, and it is a credit. Investing abroad is an export of capital, but it's recorded as a debit. Let me clarify this, because it's slightly counterintuitive. When a country borrows money from abroad, yes, it owes a debt for the future. But right now, in this given timeline, foreign currency is flowing into the country. Money in means credit. Conversely, if you invest your money in another country, say buying real estate abroad, you are acquiring an asset, sure, but you are sending your money out to do it. Money out means debit.
Which brings us to Section 5, the golden core distinction, the ultimate rule.
We've mapped the rows, we've tracked the flows of trade, transfers, and capital. Now for the secret key to truly understanding how this entire matrix interacts. The current account directly shifts a country's income levels. The capital account influences the volume of assets a country holds. I want to explicitly state this rule because it is the fundamental dividing line of macroeconomics. Current account receipts, like a huge surge in exports, increase an exporter's income directly, right then and there. It impacts the national income immediately. The capital account, however, doesn't directly shift current income. It just changes the asset portfolio, the overall volume of what a nation holds or owes in the long run.
So this brings us to a final, absolutely vital question to wrap up our explainer. If the money flowing out consistently exceeds the money flowing in, creating a dangerous disequilibrium, an unfavorable deficit in the balance of payments, what drastic measures must a nation take to fix its ledger? Do they devalue their currency? Do they use the central bank to aggressively control imports and promote exports? Do they seek massive external assistance? I'll leave you with that provocative thought to ponder. Because understanding this matrix isn't just about accounting. It's the first crucial step to understanding how nations actually survive, thrive, or fail on the global economic stage. Thanks so much for joining me for this explainer. Keep analyzing, and I'll catch you next time.